Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, for starters, I wanted to ask you if there is any risk in the way financial markets are pricing in growth. The US markets had 62 all-time highs in 2017. Is there a risk that the markets are already frothy?
Well, certainly if you're looking at price-to-earning ratio, PE ratios in the United States, they seem to be high. There's one measure, there's the cyclical adjusted PE ratio that my former colleague at Yale, Robert Shiller, has derived and is already 2 standard deviation above the historical mean. There is a sign that either a significant correction can occur over time, or if a correction were not to occur, that over the next 10 years, equity returns are going to be relatively low, since some of the increase in valuation have been stealing some of the gains from the future. But it's also true that while these valuations are high, a couple of caveats. A correction might occur only somewhere down the line. It might take a year or 2 or 3. The fact that these measures are above historical average doesn't mean the correction occurs. Secondly, usually corrections occur only if there is a macro shock that leads to then a risk-off episode. In the last 2 years, as I pointed out, was China worries, US growth stalling worries, Fed worries, oil falling and collapsing worries. None of these risks so far seems to be high, but you need a major macro risk to have a correction. Secondly, to have not just a correction is 10%, but a bear market, you need something like a stall of economic growth. And currently, the risk of a US recession is low. So 10% is unlikely, 20% is even less likely. But it's also true that increasingly there's been a gap between Wall Street and Main Street. Wall Street prices have gone higher and higher, while US economic growth has been stalling around 2%. Real wages have been growing in a mediocre way. Many people and households have still a lot of debt, and their income growth is mediocre. So Wall Street has gone this way, Main Street has been going this way. So either eventually there is a pickup of growth that justifies these high valuations, or eventually this gap between Wall Street and Main Street is going to lead at some point down the line to something of a market correction. When that correction is going to occur is not clear, but something has to give in over time.
Would it be the tax cuts? You've tweeted and written about the tax cuts, that they are fundamentally inequality exacerbating, that they are a favor for the rich. Would you say that that could risk a year down the line some kind of popular resentment and therefore a political economy risk?
Well, you know, in the short run, these tax cuts that go mostly to the corporate sector, the corporate tax rate cut from 35 to 20%, and mostly to high net worth individual, have been boosting actually the stock market further higher, and has gone to even higher levels. You're asking me the question of whether eventually this rise in income and wealth inequality may lead to a political backlash and resentment that is going to lead then to more populist policies like restriction to protectionism, migration, and other ways of micromanaging the political system, that the private sector, that will be negative for economic growth and for the stock market. That's a risk over the medium term. In the short run, of course, these tax cuts have boosted further the business and the investors' confidence. But I think that one lesson we've learned is that this populist backlash against globalization, trade migration, is in part driven by this rise in inequality, and this rise in inequality is driven by globalization, trade migration, and technological innovations that tend to be skill bias, labor savings, and so on, and therefore that's a risk that we have to address.
Do you think that sometime in the first half of 2018 itself, we could see some smart rise in the dollar? Is that a possibility?
It is certainly a possibility. The question is how much US growth is going to pick up relative to other advanced economies, how much the Fed might surprise on the upside, inflation surprise on the upside by hiking not only 2 times, not only 3, but even more. As I said, the value of the dollar depends on not just what monetary policy growth and inflation are in the United States, but also what monetary policy growth and inflation are in Europe, in Japan, and other major emerging markets. In the case of many emerging markets, actually, their currency appreciation may be affected also by the foreign exchange and intervention policy of the central bank. The RBI actually reacted this past year to the strengthening of the Indian rupee by intervening quite aggressively. The amount of reserves has been significantly increased, and there has been even forward intervention, and the appreciation of the rupee, given the capital inflows, would have been even stronger if that intervention had not occurred. So another variable to keep in mind is how much central bank going to do verbal intervention initially and actual forex intervention as a way of limiting or reversing some of those appreciation pressures.
Well, a final question. One advice to Prime Minister Modi?
The advice will be that he has started the process of a variety of economic reforms. More need to be done, and the more those reforms occur, the more chances are that potential growth of India goes from 7% to 7.5%, from 7.5% towards 8%. But to get to 7.5%, 8%, current policies probably are not sufficient, but more needs to be done. And if he wants to pass to history with the legacy of having changed for the better India, definitely he should be continuing the same policies in the near future and so on.
Thank you very much, Dr. Roubini, for speaking to us.